Hi, everyone. Hello, everyone. My name is Anastasia Bonholtzer. I am a mortgage broker with AMS Mortgage Services, part of the Affiliates and Action Committee, and would love to bring education to all of my realtor partners and all of their clients. So today is a really hot topic. I'm actually a certified divorce lender. What that means is I have special training in order to understand the transaction when it comes to divorce. I work a lot with family law attorneys. And then today I bring my partner, Vic Melillo. So Vic, I'm going to give you a little bio here just to let people know of your wealth of information. I mean, it's just, thank you for your time, obviously. So Vic Melillo here has over 40 years of credit reporting industry experience. Vic, I don't know when you started in diapers. I'm just amazed. 40 plus years. I mean, that's quite the number of years. So it started when he pulled his first credit report at the age of 12 years old. He then went on to co-owning and now operating a national credit reporting agency. Vic has provided credit reports, credit scores, all services lenders need for decision making to close loans, services provided to banks, mortgage bankers, mortgage brokers, housing and counseling home buyers, agencies, and real estate professionals nationwide. And we're here with Premium Credit Bureau. So if anybody needs any credit counseling or credit, anything credit, obviously Premium Credit Bureau should be your go-to. So Vic, welcome.
Thank you.
So divorce, such a fascinating topic, yet something that can be simply simplified by knowing in advance what to do and what not to do. So let's kind of jump right into it. I have 5 questions specifically, and as we go through, and if more questions arise, and if anybody in the audience wants to ask a specific divorce-related question, feel free. So just to start into it, what happens to joint credit accounts after divorce? Who's really responsible? So kind of tell me a little bit about that, Vic.
Yeah, no, that's the biggest thing. So we have two individuals, each signed equally responsible for a credit account. And in the eyes of the creditor, you are both bound to the contractual responsibility of that debt. So until that account is closed and terminated, each individual is on the hook, no matter what the divorce decree may say or point responsibility to the other individual.
Yeah. And so it goes with all credit accounts, I imagine, the same with mortgage. You know, oftentimes people come to me and say, I have a house that I own. I share the mortgage responsibility with my estranged spouse, but we're also on the deed. I'm just going to write him out of title. And that's a false assumption, thinking that just because you get somebody out of the deed, the title portion of it, that somehow the mortgage liability just goes away with it. No, those are two separate things. That mortgage still remains on somebody's credit, and you have to refinance out of that mortgage in order to personally no longer be a guarantor for that property, even if you give it to your ex. So, what are some of the horror stories you've seen through the years of people who maybe perhaps didn't do it correctly, or maybe the spouse in the middle of a divorce process stops paying the mortgage? What happens?
Right, right. So I'm going to answer that question. I just want to back up and say everyone at the first sign of turmoil in a relationship should access a copy of their credit report. Get a snapshot today of what my credit report looks like, what all the credit accounts are existing on my credit report. And then as things progress, unfortunately, they weren't mended, right? So now we're at that point of separation, legal attorneys are hired for us. But I like having that snapshot of credit that at that point in time, because down the road, if things change, if there's any illicit activity, one spouse wants to try and open credit in another spouse's name, or charging up crazily on credit cards, I could see prior to the filing of this divorce, here's where the credit was. Now today, here's where the credit is. And we do see time and time again the horror stories that you're talking of. No matter how amicable the divorce may be, hey, Anastasia, we're great friends. We still talk to each other. We have the kids involved. You can't predict the future 5 years, 10 years, 20 years out, what may happen. But your name, going back to your question of mortgage, is always attached to the lender that has financed that account. The divorce decree could say unequivocally, spouse A or spouse B is unequivocally responsible for this debt and all payments. Well, that protects you if there's any litigation, judgment activities, or really the responsibility of that debt payment. But in the creditor's eyes, spouse A and spouse B sign that document and they are on the hook. Okay. Meaning with
Really good
regards to
point.
the reporting on your credit report. So they stop paying that mortgage 5 years from now for some reason, it's a negative reporting on your credit report. So that's where you need Anastasia
And
to
then the
hopefully.
spouse take that divorce decree and go to the creditors and say, hey, you know what? There's 6 late payments now on my mortgage. I'm in a pre-foreclosure. I'm still attached to the mortgage note. What happens then? Can this divorce decree essentially be used to get the person's credit back up, or no? How do the credit bureaus look at these different legal documents and orders in place?
So perfect example, right? We want to dispute an account. The mortgage has gone delinquent. You could send the divorce decree. You could have your attorney hand deliver the divorce decree to Experian, TransUnion, and Equifax. They're going to look at it, contact the creditor, and the lender's going to say, spouse A and spouse B each sign this mortgage note. So as far as we are legally correct in reporting the delinquency on that account. I've
Wow.
had very, very rare instances where, in going to the lender would stop the reporting under one spouse because of the divorce decree. But in the end, if that mortgage is going
No
south,
guarantee though. It's very lender specific. So
yeah,
I
I would
imagine there's
say
no guarantee.
slim to none,
Yeah.
chance of that happening. Because at that point, if the one spouse is not paying, why do I want to give all the responsibility, securitization of that debt to the spouse that's not paying? I now have another disinterested party on the hook that's going to make sure this debt gets paid and brought current, possibly,
Yeah.
for it. So that's where the creditors, unfortunately, will continue to report that negative information.
So here's the timeline. So a couple, they've already filed for divorce, and they share joint credit cards and perhaps a mortgage. And, one party gets mad, stops making payments. How would the other party protect themselves against these reoccurrences? Could they freeze the credit? Could they take themselves off of that credit line at that point? How would one protect oneself?
Yeah, and they're all great, great points. Freezing your credit report is only going to protect you from the other spouse opening new credit in your name. Okay, but with all that existing credit, it's a joint credit card. Typically, that credit companies are not going to release that joint responsibility. I would need the responsible party to open a new credit card with that creditor and transfer the balance from the joint card to that individual account in their name. But you want to know that that account is closed and is zero balance. And
Wow.
if that's
Okay.
not the case, you are at risk eternally, let's say, on an active account, that they could miss a payment or mar your credit profile.
If I'm the wife and then the husband's racking up debt and I want to get him to stop using that credit card, since it's the joint credit, am I able to call, let's say, Capital One, US Bank, and say, I need to put a hold on this account, and to prevent the other spouse from using it? Is that an all thing?
Anastasia's super PowerPoint that you're bringing up. Yes. So you would contact that creditor and say, I want to close this account. This way, no additional charges can be made, because we know things get ugly. I've got that card. I'm going and buy to the max of the credit limit, thinking, the other spouse may be responsible for this debt. So to prevent that, yes, joint credit cards, I would contact each of them stating, I want to ensure that there are no future charges made on this account. the other spouse may beg you, please keep it open. We need some open active credit. I promise I'm going to pay that. Great. Go get your own credit cards in your own name. But
Yeah.
every joint account should be closed for that type of protection.
Yeah, and that's what when I counsel, I do a lot of counseling with divorce clients, mainly women trying to get out of toxic relationships. And I tell them before you start the divorce process, open 2 or 3 credit cards under your own name before the judge will potentially order you to close all joint accounts where you now have no established credit under your name if you
Right.
have no individual credit to begin with, apart from the joint accounts.
Yeah. And
Is that true? I mean, what else would you say in that situation?
yeah, no, I think that
Based on
you're
history,
given
joint accounts.
tremendous, right? You're given tremendous advice because the credit scores go off of activity. So if at a particular time, let's say this married couple had nothing but joint accounts. Well, if we close all of those accounts, you're removing the reporting activity. In 6 months without activity, you don't have a credit score any longer. You need activity within the past 6 months. So giving that advice and giving that timeline to establish and let those accounts season for at least 6 months helps preserve that person's credit profile and credit scores to remain strong at the point in time if they're heeding our advice to close all those accounts.
Yeah. So what happens to the actual score? Let's say I do share an account with my estranged husband, and I've had the account for 20 years, and it's my longest running account. And now, by force of the divorce, I'm closing my longest account. What kind of impact to the credit score would that be? And how long after that impact is made, how long will it take for me to recover from this? Because
Yeah, no,
that's something
excellent,
that
great.
must occur.
So it's going to look at the length of your remaining open accounts, in your name. So if that's your only 20-year account and now everything else is 1 or 2 years old, your score is probably going to take a little bit of a hit because you don't have that great length of
A
history.
little bit like 10 points. People always ask me, like if I close an old account, is it like 2 points? Is it 10 points? Is there a magic number? Is it 100 points? Is there?
Yeah, I wish I could give you a blanket answer on that, but credit reports are like personalities. Everyone is different. So in certain cases, I've seen people close 2 or 3 accounts, have no impact on their scores. I've seen people close 2 or 3 accounts and have tremendous impact on their scores because again, it how many of those positive, needy accounts are we removing from that profile?
Yeah, that's a good one. I like that. It's like a personality, and that's what I tell my consumers is could be
Yeah.
2 points, it could be 10 points, it could be 50 points. I don't know. We won't know until it happens with the algorithm that the FICO system will have. What about divorce? Can divorce itself damage my credit score if I pay everything on time?
You know what? Anything that's not reporting on your credit profile has zero impact on your credit score. So the only impact ever to a credit profile is what is the story the creditors are telling about you. So it's just any negative impact to your current credit trade lines, yes. But the fact of filing divorce, being arrested, let's just say, that would have no impact ever on your credit score because that is solely focused on your ability to repay
But
debt.
somebody ex-convict who pays all their credit cards on time, but has a couple of bad boo-boos, could have a better credit score potentially than somebody who has a clean job, never did any criminal activity.
Well, yeah, because credit scores don't know how much money you make or how much you have in the bank. They just know who and how you're paying people. So this is not a
So being
reputation.
single, being married, it doesn't matter. Credit reporting
Right.
agencies do not care what your dating status is or marriage status, and it has zero impact to the credit score.
Correct. Correct.
Uh, okay, I want to just give it a shout out to Stephen Carollo. He is a title rep. If you need anything related to title, I just want to give him a shout out. Just it has been essential in my own business making. Okay, and Stephen, you're welcome to put your info in chat just in case people have any information or want to potentially farm for credit or divorce leads, divorce potential, figure out who's getting divorced in a specific farm. I think that could be a strong avenue for a lot of agents. Now, my follow-up question is, how do I rebuild credit independently after divorce? Let's say You know, things took a turn, a couple of late payments, and now I'm divorced. What can I do to recover from that? Because it is my understanding that any late payments stay on the credit report 7 years. Is that true, or is that a myth? What happens?
No, absolutely. The statute of limitations for legality of reporting information is 7 years, and it's 7 years from the date of last activity. So you could have a credit card on your profile for 30, 40 years that's open and active. But if there is when an account's closed, it'll remain for 7 years from the date of closure. If it's a paid debt, positive or negative, 7 years from the date of that last payment when that account was paid in full. And if it is a delinquency reporting, the clock starts ticking from June of 2025. And I'm going to say, great, I should no longer see this on my credit report in June of, wow, 2032. Boy, that makes us. that's a,
Feels
that's a,
like 2020 was or I'm sorry, 2000 was like, 2 years ago, and instead it's like, 20, 30 years ago now.
yeah,
You're
yeah.
right. A powerful message there. I love it. In the audience members, do we have any questions related to divorce and how that has impacted your clients? The reason for this webinar is to make sure you understand that yes, divorce can impact one's credit, but adequate counseling in advance of filing for separation is essential. And having Vic to be on your side, he has an ability, apart from me pulling credit, he has an ability on the consumer end for the consumer to pull their own credit. Can you tell me a little bit about your company and how your company can help somebody who's going through a divorce or considering divorce, as it pertains to their lines of credit or salvaging their credit or anything like that?
Sure, sure. Absolutely. So as we spoke earlier, that you do want to monitor your credit, right? Get a snapshot, and maybe it's something you want to do monthly on there. If you don't have concern about the credit scores, but I think that's very important with litigation. Hey, my score was X on this day, and now it's sank to Y. I mean, there is the free site, annualcreditreport.com. Everybody can get a free report each year from there, but you're not getting your credit scores with that unless you're paying an extra fee. And it's not a simple merge of the credit data like the report Anastasia accesses from our company and provides to you. If you're not at the loan financing needs, financial expert advice for Anastasia, then you could visit a site which we have developed called My Mortgage Score. And at mymortgagescore.com, you can get a copy of your tri-merge credit report with mortgage scores. Obviously, the most strict scores for the highest amount of financing that we're looking for.
Yeah, that's a
Versus
good point.
something that
And
you could
why
pay
have
for.
you developed your website? Because people often come to me and say, you know what, my U.S. bank shows that my FICO score is 780, and then when I pull, on my mortgage credit bureau system, thanks to Premium Credit Bureau, the credit is like maybe 718, and they're thinking, what did you do to my credit, Anastasia? And why is my credit card telling me one thing, and then when you pull the mortgage FICO score, it's something different? Tell me a little bit about why there's a difference there.
Yeah, so there's variances in score models, and there's variance in score model providers. So FICO, we all know Fair and Isaiah companies. FICO is the leader in financial decisioning usage today. Vantage Score is a credit bureau created model. Gaining Strength could be implemented later this year or next year as another decisioning score model for you. But when you go online, credit card companies using credit card scores, uh, the popular Credit Karma, a TransUnion Vantage score only. So it's one score and a totally different model. So it comes down to lenders are deemed to use specific scoring models nationwide. Okay, so no matter where you are, these are the models all of my clients nationwide are pulling and utilizing. And that's the big difference when people go and say, Anastasia, I'm good. My score's over a 700. And then she pulls it and it's a 670. And they're looking at her going, was that your inquiry? No inquiry ever impacts a score more than 2 to 5 points. But it's the difference in scoring models. And that's why you would have such a variation.
And so the impact here with the website you've developed is it actually provides a consumer an ability to look at the mortgage score FICO system, as opposed to
Yes.
a general FICO that there's available It's not Credit Karma. It's not even the FICO score that's available through their credit cards.
No, exactly. This is a soft pull, so there's no hard impact inquiry because you are requesting your own credit report. And then in addition, it is the identical report, and it's going to look just the same as pretty much any lender would access in all 50 states. And the scores will be identical to what they would be using.
I personally love this because a lot of consumers come to me. They're like, I don't want to do an application with you. I'm not ready. I'm maybe 2 to 5 years out from purchasing a home. Having the consumer give them the ability to pull their own soft credit history to understand where do they stand as it pertains to their mortgage, their potential qualifications, that's huge. So thank you so much for dropping that in chat. Write that down. If any consumer who's a little shy from talking to a lender, I mean, we don't bite. We also, it's like, it's funny. People think somehow I'm going to like chop their head off by talking to me. Free consultations on my end if you just want to have a general conversation. But if for some reason they're a little gun shy to talk to an actual loan person, going through Vic's website, that gives the ability for a consumer to pull their own credit and to understand what do mortgage professionals see when they pull their credit. Is there a way, going back to divorce, because I know that's still a hot topic of ours. So if the husband, does pay, I don't want to mean to say the husband, it could be the wife, I don't care. If the one party decides to pay some joint credit lines late during the divorce process, and divorce lasts, let's say 2 years, because the divorce seems to be lasting longer and longer these days. Could potentially the spouse who didn't pay the lines late go to the credit bureaus and say, I was going through a divorce. Oops, my bad. This and that. Is there anything that can do? Do credit bureaus care of somebody's financial hardship? Could they remove the lates down the line with that excuse in mind?
I would love to say yes, but I'm going to say no. I mean, the obligation debt was made and paid late. We would love for them to have compassion. Certain creditors, if you do go to the creditor, you may catch the right person on the line. I tease sometimes, and I'm saying, look, when you call, hopefully you get somebody on the line that has been through divorce, because all you're looking for at that point is a courtesy removal of the delinquency. Yet, what can we do to prepare ourselves to avoid that from happening? Hey, every joint account, as you're monitoring it, I would make darn sure I have online access to that account, and I know that that account is being paid. I know extra homework, for the individuals, but to protect my credit history, we have 11 joint accounts. I'm signing in and making darn sure there's going to be notifications, payments approaching. Payment is, a day past due if there's a little grace period. But I would want to monitor every single account to ensure, per our agreement, A is paying the 5 accounts they're supposed to, B is paying the 5 accounts they're supposed to avoid that inability of one day one spouse needs to move out of the house. I want to buy a house, and if my credit's marred, I might have an inability to do so.
Yeah. And is it important to put everything on auto pay? Because I know some people still like to think that paying everything off, in full is a better strategy than having potentially things on auto pay. What do you recommend usually?
I totally recommend today that there's no reason any person should have a 30-day delinquency reported on their credit card. Set up every credit card with just an automatic payment for the minimum. This way, if there is a brain lapse of some sort, some reason that you did not make that payment, at least the minimum payment is coming out of your account. Obviously, your checking account needs to have ample funds to cover those minimum payments. But with that said, at least there isn't that I was away, the mail was lost type of scenario, or I just forgot, things that creditors will not. The only real reason creditors give a courtesy removal is change of address. Something plausible that I did not receive that bill due to a change of address is the number one reason that you can get them to give you some courtesy removal of the delinquency. And then the other could be I did have the auto pay set up, but maybe there was something incorrect at the bank level to evidence funds were there. They just didn't process properly. But
Yeah.
without that, you have to just hang on and hope you do get somebody who is with a big heart to give you that
Do
courtesy
they even have
moment.
authority? So when I call a credit card company and I say, okay, Mr. Rep from, the Philippines, last month I started my divorce. I'm so sad. I start to cry on the phone. I tell them, I'm a single mom. I have an 8-year-old. I'm not resorted to food stamps because my ex-husband won't pay for anything. You know, do they have the authority, or should I automatically start to talk to the upper management level? Get on the phone and say, I need your manager, or I need
You
your
know what? Yeah.
supervisor.
Powerful, powerful question. And what I like to say is make sure you're speaking with domestic support if you can. Because a lot of times when they're farming their customer service overseas, they're they're reading a manual and it's just saying absolutely not, did not pay, you're stuck, thank you very much, and because their first job is to do what? Substantiate it and not offer you any courtesy. So yes, you would have to probably get to a higher level than that customer service individual that doesn't have the ability to log into the system and click remove the delinquency, or at least submitting a request to parties within the company who's in charge of credit bureau reporting and getting your story to them to see what can be done.
Yeah. If somebody is, they didn't listen to this webinar, they didn't hear all these wonderful tips, and they've gone through divorce, they've closed all their joint accounts, and now they're basically starting from scratch. What would you tell a person like that? They have essentially closed all their joint accounts, and they need to start from the bare minimum. How many credit cards should they open at the same time? Is there certain credit cards that are better than others?
Sure, sure. So I definitively like the bank issued credit cards over department store cards. Most are backed by banks today, but definitely look for a card that's used at multiple places in opening. 4 to 5 active revolving credit card accounts is kind of the magic number, obviously combined with loans, but Anastasia can speak from underwriters when they look at trade lines and they're looking for people to have 4 active accounts, 3 credit cards, 1 loan, 2 loans, 2 credit cards, whatever that combination may be. But as far as the credit scores concerned, we need activity. The account needs to be 6 months or older, so it fully factors in with the scores. And in starting out, hey, you may apply for American Express or a MasterCard and you may get a declination letter. And you're like, uh-oh, I'm stuck. I'm never going to get this. Well, now you might have to step it up to what's called a secured credit card. And popular ones are Capital One and HSBC. They have some secured credit lines. I tell everybody, Google secured cards. Find one that does not have an annual fee. Could be the best. And bigger is not better in this scenario. So when
Mm.
somebody's looking to open a secured card and they're like, Vic, I opened a $3,000 secured credit card. That's going to be great for me, isn't it? And I go, well, you need additional cards. Oh, I don't have any more money. I'd rather see you open $300 secured credit cards so you're managing the strength in numbers. Because I like to say, again, we talk about personality. It's like Anastasia saying, hey, Vic's a great guy. Well, that's one person, right? On there. But if multiple people are saying Vic's a great guy, then the audience might say Vic's a great guy. Well, that's how your credit scores work. You need multiple creditors saying you can pay me. So the credit scores say you're great. Here's a great score, 700 plus.
Yeah. What about so somebody is starting out from scratch, literally no FICO score whatsoever, and they do open those 2 to 3, 4 credit cards that are small. How long does it take for those cards to be in use, and what usage would you recommend before FICO scores do show up?
Good. So 6 months is the minimum. So once they have 6 months of activity reported to the credit bureaus, now your score will generate. And it's okay to charge up on those cards. So if they're $300, $1,000 limits, it's okay sometimes to charge up close to the limit and then pay it off. But when you're managing that account, I like to say, the best strength in a score is keeping tiny tickling balances. So we always say keep balances 50% or less of the credit limits. But if you could, 30, 20, 10% is kind of magic score boosting numbers because you're showing credit utilization, ability to pay. And here's something really key, everyone, that a lot of people miss. They go online, They make a charge today. They have this great fear of that account going late. So 2 days later, they go and I made the online payment to my creditor. What gets reported to the bureaus is what your credit card statement reads when that statement is generated. So if during the month I've charged on that card 900, but I've paid it off, my statement generates on the 26th of June, now having a zero balance, they report to the bureaus, you had a zero balance.
Mm.
So you need a statement to generate with a balance, and then you can pay it off, let's say right away, so you're not accruing interest charges. But I want that continued activity each month on various cards. Make one card your gas card, make one card your dining card, make one other card your utility bill card. Okay, and you could set it up on auto payments to pay it in full every month after the statement is generated, or at least make the minimum payments. But you need that continued varying activity on those cards.
Yeah, no, those are all, I mean, these little nuggets, I mean, it's good for even somebody not going through a divorce. Um,
Correct.
how many people can you have as a co-signer on your credit card? Let's say, what if do you have to be a husband and wife to open joint credits, or can boyfriend, girlfriend do it? Could two friends open a card? And what would be the advantage or disadvantage of each of those scenarios?
Yeah, so super point that you're bringing up, and I tease about this at my first time home buyers and everything, but I say I'll be married 30 years and my wife and I still do not have a joint credit card account, okay? And it's not for any other reason than I'm a credit guy and that's just how I operate, because in reality, we don't need that joint card, right? We're not walking in the Home Depot together and she's holding one side and we're saying we're taking our joint card and going shopping together. So there's really no reason to have that joint debt together. Definitively not with significant others. I mean, joint cards, you're married, you're in love, yes. But a roommate, a significant other that we've kind of been hanging out for a couple years, keep your credit independent and separate. You sleep well at night. And if there is any, separation coming about, you have no worries.
Yeah, yeah. Do I have any? So we're going to go into a Q&A kind of session. Nothing else is coming up in my mind as it relates to credit. I mean, this has been super essential, in my opinion, for individuals going through a divorce and everything related to credit. I think this is a really comprehensive way for us to understand that credit is important. You do need a credit score. I do have some consumers that are high net worth who are cash, and they think by not having a FICO score, that's a good thing. We live in a very credit heavy society. We are not a cash based society. You need to use credit. Unfortunately, but wisely. It's important to have everything on auto pay, keep the balances low, and do not share joint credit with anyone apparently. And I like that tip, Vic. It's under the assumption is as soon as somebody gets married, they automatically open up a bunch of joint credit cards thinking that's a good thing. No, it's not. So we have a question coming in here in the audience, and you're welcome to also unmute yourself, but I'm happy to read it. Can you clarify when statements come in versus when they start charging interest on the balances? Good question.
Yeah, that is a good question. And typically with some, it's going to vary by creditor as to when they accumulate that. So some will start charging interest on the charge pretty much as soon as it's hitting that file, feeling they've given you a 30-day extension of credit already on the debt and the balance. Others, it'll start accruing the interest on the date that statement is generated with that balance. So June 26th, you had a $2,000 balance on that account, and now they're going to start accruing interest on that balance until you pay, that amount in full.
Yeah. And
On the
then what do you think about credit transfers? I've seen that kind of more common in the recent years. Let's say some people, unfortunately, accrued a lot of debt during COVID. We had some free money coming in. Now we're used to a certain lifestyle with all of those federal little checks in the mail, $700. We all got those. And then suddenly we live in a society now where everything is more expensive. We have a lot more credit card debt as a whole. And I've been seeing people utilize the balance transfers credit cards. Let's say you open up a new credit card, you can balance transfer that amount to a new credit card for 18 months. Is there any negatives to balance transferring? And what do you think of that?
Yeah. So you know, the balance transfer is something, a great advantage, right? 0% for 12 months. It'll help you become debt free, pay your debt down faster. But I can initially state, if you are thinking or beginning or in an application with Anastasia, you do not touch or accept any of those new offers for credit. Why? Because it is a new trade line. It's typically going to be reported as a maxed out trade line on your credit, and it's going to take time to season to prove to the FICO score models, can you afford that new debt? Will you make payments on it? So it could drop your score. I had someone that literally was paying zero interest on their credit report because they were the master of balance transfers. And they showed me, they had an amazing spreadsheet of how they were getting it, 12 months coming up, getting new cards, and going through this. But their score suffered because they didn't have an open trade line of longer than 12 months because they kept closing and opening, closing and opening. So they had a very young credit history, let's say. So it can be detrimental. Great benefit if used wisely and not during or before a mortgage process, but afterwards to help you become debt free, I think you can take advantage of some of those offers, but again, not becoming someone that now just has a habitual 20,
You don't
30
want to do
credit
it in
trade lines.
combination with other types of credit. And that's what I always want to mention is you don't want to open a new credit card, then go shop for a car the same week, and then also then go to me and try to get a mortgage. That three different types of trade lines can severely impact somebody's score, dropping it more than 100 points just based on the hard credit, not even taking out the credit. Is that true?
Yeah, so I mean, we're talking about inquiries, right? The inquiries are for your protection. Nobody can access your credit report without permission, okay? But they can also work against you because what is an inquiry? You're asking for money. So if I'm on this call and I'm saying, Anastasia, can I borrow 50 bucks? Stuart, can I borrow 50 bucks? Nicole, can I borrow 50 bucks? By the time I get to Nicole, she's going to go, Vic's crazy. He already got $100 for them. I'm not giving him 50 more dollars. And that's what happens with too many inquiries is you've asked too many people for money. What if you do get the money from all of them? Are you going to be able to pay everybody? Or are you going to pick and choose and maybe stiff a couple people and, reward the others? So you want to limit inquiries. You can't have a fear of the credit inquiry. You do need to have it happen for a transaction. But like Anastasia said, hey, don't run out there and have auto, credit card, mortgage, student loan, whatever it may be, because, and an inquiry only remains on your profile for 2 years, factors into your score for like 90 days,
Okay, good
because they
to know.
feel after 90 days you did get the credit extension or you didn't, and then that impact will start to go away. But, it's the bureaus, right? It's a little tattletale. You ask too many people for money, so your scores are going to suffer a little bit before we realize how much did you get, and then your scores can strengthen back up when the scores feel you are financially sound.
Yeah, love that. I have one other question in the audience members, and then we'll wrap this up. As my client is wanting to buy, but has a car loan coming up, not sure pay off or save for down payment. How would this impact credit scores? $30,000 loan balance. I'll start with from the mortgage perspective. What we look at when somebody has a car loan is it a lease or is it a purchase? That's question number one. Are you buying the car or is this going to be a lease where eventually you're going to get another lease after this? The second question is, instead of the loan balance, what we look at is how much is that monthly obligation? So is the monthly obligation $400? Is it $1,000? And how does that affect the debt to income ratio when it comes to their mortgage qualifications? So each of that is very individual. It's hard to say based on just this forum whether or not I would advise that client to pay off the car, because they may not necessarily need to if they make sufficient income to support the mortgage they also want to get. So it's hard to say, but the rule of thumb is every $600 of debt, and that's the minimum monthly obligation, whether it's credit cards, student loans, car loans, it's irrelevant. Could potentially shave off $80,000 to $100,000 of somebody's purchase power, meaning every $600 of debt, they no longer qualify. It's basically approximately $100,000 worth of loan that they no longer qualify for. So having less debt overall, is better because you can get then more loan for the home. But if somebody wants to buy a little 1-bedroom condo, you know, and then obviously you need a down payment for it. Although I do have down payment assistance programs, maybe it's not a factor to pay off the car loan. Vic, anything to add? I mean, that's pretty much more of a
Yeah,
mortgage.
you know, from the credit aspect, you know, I like that cash is king. So don't deplete your savings to pay down debts and not have reserves or down payment, you know, money. Always seek the expertise of a financial expert like Anastasia to direct you what to do. But from the credit aspect, I see people paying off an auto loan, and guess what? They might have a negative score impact. I know you just fell off your chair. Why? Because you took away a proving payment that was showing your ability to pay. If you have other loans, okay, it may not be an impact on there, but sometimes I'm looking at it and going, you need that proving monthly payment that you're doing each and every month on that auto loan to keep the strength in your score. So
That's a
again,
good point.
financial experts will direct you best, but with regards to credit, sometimes it may be better to continue to pay that monthly payment on that auto versus paying it off.
Yeah, I love that. So any other questions? I think we'll wrap it up. I mean, divorce and credit and everything credit cards. I think it's been a very, very good information for all of us. I mean, I've definitely learned quite a bit from a credit perspective. Keep your credit high. From a mortgage perspective, you want to make sure your credit is above 700. That seems to be the magic ballpark. We do pull credits using soft credit inquiries. What that means is Vic is able to pull soft credit. Soft credit does not have any inquiry, so it does not negatively impact somebody's score. What that does is that pre-approval essentially does not expire. As with a traditional credit pool, a hard inquiry will expire after 90 days and we'll have to repull the credit again. So having that soft credit pool is essential for a mortgage, in my opinion. And, you know, reach out to me with any loan related questions. I am licensed in California. I just became the PV specialist as well. I did the PV specialist designation, and I'm licensed in California, Texas, and Florida. And Vic, I think you're nationwide, right? You can pull anybody's credit as long as they have a breath and a social security number.
And a signed authorization.
Okay, love it, love it. And then Margot is asking if she can have your contact info. Do you want to drop it in chat?
Yeah, I'll drop it in. And anyone, if there's any questions I did not answer today, please say you were a guest on Anastasia's seminar today, and I'd be more than happy to answer that for you.
Awesome, awesome. Thank you so much, Vic. All right, thank you, everyone. And we're over and out. Have a good one.
Thanks,
Thank
everybody.
you.
Thank you.